This conference will now be recorded.
Okay, let's see where we are. And as you know, we've changed our approach because we're now moving to planning. And so a key focus here is planning for the future, separating costs between fixed and variable, and determining break-even point, how many units are necessary to earn a certain profit. And this is a standard thing that businesses use all the time. It's a standard thing. And so I gave you these three formulas. Do you all have them memorized yet? Do we have our formulas memorized yet? Okay, then we go to the master budget process. And our goal with the master budget process is always to see where we are cash wise and have integrated financial statements, balance sheet, and income statement. And so we looked at a situation where a company was having to borrow quarters 1 and 2 and 3, but then made income. And we stated that if you didn't have a plan to borrow this money, then you'd be out of business. And so you have to have these projections, get your line of credit available before the year starts. And then we can move on to a situation where we got a net income at the end. But if we don't do this ahead of time, it's all businesses do this. They lay out what their income is going to be, and we're using quarterly. They see where they need to borrow, with the idea that most of the income is going to come in at the fourth quarter. Now, when we move to a manufacturing company, such as the company that will be handling uh, the production of your product that you've made, you bought your raw materials and you have it made, it's a little more detailed because we got to have sales budgets, production budgets, direct materials, direct labor, manufacturing overhead, then the cash budget, a budgeted income statement and balance sheet. The key thing is that these have to tie together. If you go to a bank and you don't have financials that tie together, then you're not going to give a loan. They can't make a loan if your financials don't tie together. And so what I've attempted to do is to come up with an approach where we're going to have a cash budget, but we're also going to have a budgeted income statement and balance sheet. But the income statement and balance sheets are going to be based on journal entries that you're familiar with. And we make these journal entries, we will get to the point where we will post them to the ledger, do a trial balance. And so it appears to be an involved process. But as you work on this, you simply got to say, okay, we've got to delegate this work to various people. So you have the assumptions, everybody would do those. Then you have a sales budget. One person works on that. Then we have a production budget and these budgets, a person works on that. Then the selling and administrative expense budgets. And then as everybody's working and feeding in, we get a cash budget and integrated financial statements. And so there are 8 budgets here, including capital expenditures. You people as we get ready for the first year. Strong person should be on the sales budget and these production budgets. So this is where you need your top people. Manufacturing overhead, selling, administrative, and capital expenditures are not that difficult to work with. But if you get all of those allocated to various people, then you'll be in good shape. And the idea is that we're going to use these budgets to get that, that cash budget we did for the retail company. We could just go and put the numbers in, but we won't be able to do that. And so we're going to use these sub budgets here, and that's going to give us the information. Number one, the cash that's expended. That's number one. And number two, journal entry, so we can do the income statement and balance sheet. So I provided you detailed information on each of these budgets. So you just have to get this assigned to everyone. Like I said, and we're going to come back to this cash budget, sales and cash budget, in an example, but that's the first one. So the budget tells you what you're doing, and it tells you the journal entries you got to make. It's telling you the journal entries you have to make, which you will post to the ledger so you can get a trial balance and get those financial statements done. Here's the production budget. The production budget controls what's going to happen with raw materials. But you got your journal entries, direct labor. And you have to have a production budget for each item you make it. Then we have the manufacturing overhead budget. It's just a basic budget. And we typically, so standard journal entry, that's not a hard budget to do, and we'll see. The selling expenses and operating budget, that's not difficult. Administrative expenses and capital expenditure budget. So these are sort of standard ones as we get into. So you just go ahead and get these budgets assigned to various people. Then we have the summarizing cash budget. And then we're going to get those financial statements prepared, because we got every entry that we made all through here, all of these entries, we got to post them to the ledger, get a trial balance. And then we get a direct costing income statement, balance sheet, and closing entries as we move to more than 1 year. So here is our in-class problem. Let's see if we can see what's in this in-class problem. We have quarterly sales that's given to us, and they've given us a selling price. All it says a credit because that simplifies it. And then we have these collections. We get 40% in the month of sale, 50% the month after sale. And we'll come back and talk about that for a second. Then we have the assumptions for how much inventory, and we're just keeping finished goods inventory. We have the raw materials, ink, we have the paper. Then we have how we're paying for it. So before, in that simple example, we paid everything in that right away, but we don't pay it that way all the time. Direct labor budget, manufacturing overhead. Notice these numbers are quarterly, so you have to add them together to get a full year. So these are the assumptions that you will need. And in a few minutes, we're going to get our master budget quantity solution. So this is a starting point, and everybody works on this to make sure this is correct. Because if you don't have this correct, there are going to be problems as you go through. And we probably will just do this on the Excel spreadsheet. So we're going to work on this table first in a few minutes. Then we got the sales budget and cash receipts. We'll work on that next. And once we get that done, we work on production, raw materials, and the other budgets. And the other ones fall pretty easily. Now, a key thing that we're trying to do is to get our cash budget done. And so we're going to get information from all of those sub budgets to determine how much cash receipts we have and what's available. And then we're going to get our disbursements, total payments, whether we need to borrow, and the ending cash balance. So this is how this looks. Before, we didn't have a lot of disbursements, we just have two. So we have more than one, we just put them on schedules, but they will fall into shape. The journal entries, we have them here, but the journal entries that we make are going to be the same all the way through. The journal entries are going to be the same. So the ones that are listed in those handouts, they stay the same. You just got to get the amounts. Okay, so as we're prepping, and as we're getting ready to determine how many we're going to make, and as we work on our assumptions, I'm going to insert a column to the right. So I'm inserting the column to the right. And this is the column, I'm going to call this the CVP column, CVP. And so I'm going to use the information here to come up with, let's see what. Okay. So we come up with the assumption so we can get, our quantities down. Okay, so that's what we have here. But before we get to that, let's begin to look at the items we're going to be utilizing to come up with a quantity to lose 100,000. First item is selling price. So I got this in my column over here. I'm going to use the selling price to come up with the quantity to make. Okay. Since I'm collecting 40 and 50%, my bad debt's are 10%. Okay. So if I don't collect it, then that's a bad debt. So that's going to be 10%. So I'm going to take 10% of that selling price. I'm going to put this in my CVP column, $50 for the bad debt. Then the ink, I got 5 ink cartridges at 50. So I'm going to utilize that number. I got 7 reams of paper at $7. I'm going to use that number. So I'm pulling through the numbers that I'm going to utilize to come up with the quantity I need. So I'm not worried about anything else. We make 20 books per hour. So what am I going to put in this column? Tyler, what's going to go in this column? They make 20 books an hour, and it's $20 an hour.
That's one.
One's going to go in that column. So what we have so far pretty much are the variable expenses. We'll pick up one more in a few minutes. Manufacturing overhead is always fixed, so I got to add these together to get 100,000. I'm just concerned about the total overhead. Administrative expenses are fixed, so I got to add them to get 200,000. The selling expenses are 30% of sales. So whatever the sales are, the workers are paid a variable cost of 30%. So they're gonna get 30% of the 50. So they're getting what, $150? And finally, we have the interest expense of 100,000. So I pull out the parts of the assumption that I need so that I can go in here and calculate my quantity. You want break even or lose 100,000? Which one you want?
Break even.
All right, so break even it is. We'll go with break even. Okay, so if we're doing break even, what's the first thing that's going to break even calculation?
The fixed costs divided by the contribution.
No, that's not the top. Got it already here for you.
Oh, the selling price is 500.
Selling price is $500. Then I get to my variable costs and I pull them out, correct? Bad debt, 50. The raw materials, ink, is 50 also. The paper is what, 49, correct? How much was the labor, Tyrell?
1.
1. And the selling expense we said, because that's variable too, was 150. So if I add all of these together, what are my total expenses going to be? What's my total variable cost? How much?
800.
No, I said from here down, variable cost down.
250. Oh, 350. I mean 3.
300.
I'm everywhere.
Okay, so
That's
the
300, guys.
300. So can you give me a contribution margin?
Would it be 200?
100.
Contribution margin 200. Now I got to put our fixed costs in, and we have 3 fixed costs. What's the first one? Manufacturing overhead. It's always fixed. We said we're going to keep it that way. And then we have administrative expense, what? 200,000. And finally, we have interest expense of what?
100,000.
Who's that talking so softly?
Miss
Dominic.
Phillips.
So what's our total fixed cost?
400,000.
So what's our break-even quantity gonna be, Rodney? I mean, we gotta sell a break-even since you said you want to break even. What is the quantity that this company has to sell to break even?
2,000.
How many?
2,000.
2,000. Does everybody see how he got 2,000? Anybody don't see how he got 2,000? It's a smart class. Everybody see how he got 2,000. So Kyler, how did he get 2,000?
Did he do the 400,000 divided by the 200?
That's correct. So all he did was to take the 400 total fixed costs, then he divided it by what?
200.
Margin 200. So is everybody with me so far? So as you're working problems, you want everybody to make this calculation so you don't have an error. Then let's check it out right quick. So we don't want to get ahead of ourselves. So let's check it out. So what's our sales dollars going to be? If the quantity is 2,000, we're going to multiply 2,000 times what?
500.
500. What's that going to be?
1 million.
Million.
2,000 is a million. Then we just use our total variable cost now. Our total variable cost was what?
300.
Correct? Total variable cost is 300. So we're going to multiply that by 2,000. What do we get here?
600,000.
600,000. And so our dollar contribution margin is what? 400. Our fixed costs are how much?
400.
400,000.
So did we break even?
Yes, sir.
Any question on what we've done so far? So the first step is always you're going to go in here and look at these numbers. So you can take it to the bank that everything in this red column, whenever we have a problem or exam or a quiz, is going to, these items are the ones that's going to go in the CVP column. So you can take that to the bank. So you can always, you got this as a guide, just move them over there, then you should be able to move to this point. Is there anybody who don't see how we got $2,000? So 2,000 becomes what we're going to sell. So what we're going to do with the 2,000? We're going to take that 2,000 and put it right here. This is sales quantity. So that's what you do with the 2,000. As the first number, so let me put so you go and you calculate what your sales are, then you put it here. Okay, sales quantity. I got over 2,400. I should be right here, 2,000. I'll clear this for now. Okay. Okay, when were the 2,000 sold? So we go up here, look at our quarterly sales percent. And in this problem, they say 10% of the sales happen in the first quarter. Then it said 20% happened in the second quarter. Then it said 30% happened in the third quarter, and then it said 40% happened in the fourth quarter. So it's your job now to fill out these rows here. Fill them out. Can you fill them out? So how many of the books you sold in the first quarter? How many? Maybe 200. How many did you sell in the second quarter?
400,
400. How many did you sell in the third quarter?
600,
600.
How many did you sell in the fourth quarter?
800.
So the second thing you do is once you get your quantity, and we're doing break even, you'll have some assumptions about when the sales occur. You put those in, and then you move your quantities by quarter. We said our selling price was what?
500.
Our selling price is $500. Let's see. That's going to be all the way through. So it's keeping the selling price the same each quarter. So what's our dollar amount of sales the first quarter? What is your dollar amount of sales the first quarter?
100,000.
I'll take your word for it. And what are your dollar sales the second quarter?
200,000.
Third quarter?
300,000.
Fourth quarter?
400,000.
And so for the whole year, our total sales would have been what?
$1 million.
$1 million. So what have we done? So we went through the key amounts for in our assumptions so that we could come up with the quantity that had to be sold to break even, and we proved that. We then, based on the percentages, allocated those sales by quarter to show how many of the 2,000 were being sold each quarter. And so our sales are 100, 200, 500, and $1 million. And what we're going to do is make all of these credit sales. We're going to make all of these credit sales. And our collections are 40 and 50%. So we know that 10% of these sales are never going to be collected. 10% is never going to be collected. So we just say, okay, 10,000 this quarter is not going to be collected. 20,000 this quarter is not going to be collected. 30,000 in this quarter is not going to be collected. And 40,000 in this quarter is not going to be collected, for a total of 100,000. Now, when you pay your bill to TSU, and let's just say it's August, and your bill is $10,000. So your bill that the university gives you is $10,000. How did it jump up here? But put the August up here. But you only pay half your bill when you get ready to pay. You only pay half your bill in August. Then September comes, you pay $2,500. And October, you pay $2,500. Is that a scenario that everybody's familiar with? The bill is $10,000. We pay so many now, and then we pay others later. Everybody kind of understand that? Okay, so when we make a sale in this first quarter, and these should be quarter, 40% the quarter sale, 50% the quarters. If we make sales of 100,000, we only collecting 40%. Okay, so we get 40,000. That's all we getting that month. So we made the sale, just like here, TSU had the sale of 10,000, but they only got 5,000. They got to wait here to get it. So when you sell on credit, we're assuming here you only get 40% when you make the sale. Then the next month, you get 50% of, you get the rest of your money that's due. So you made a sale of 100,000. 10,000 people not gonna pay you at all. You get 40,000 in quarter sale, then 50,000 the next quarter. So in the first quarter, 40, second quarter, 50. Are there any corrections? Any questions? Then in the second quarter, when you have 200,000 in sales, 20 of those are going to be bad. You're going to collect 80,000. Then in the third quarter, you're going to get the other 100,000. So you're never getting it at that point. In the third quarter, when you sell 300,000, you're gonna get 40% of that, or 120,000. And when you get the remainder of it, probably in quarter four, 150,000. And finally, when your sales are 400,000, you're going to get 160,000, and it'll be the next year before you get anything else. So this will be year 2 here, and we won't put it in, but this will be year 2 where you get the rest of that money. So a couple of ways to look at it, but in the month of sale, you're getting 40% of whatever was sold. Then you're picking up the rest of that after the sale. So how much money are we collecting? In total, here we're getting it's not going to sum across for me. Let me just sum it down. So my total sales are 40, 130, 200, and 310. So my total collections are going to be 700,000. How did I get over there? Don't be doing that. Put my 40,000 back down. Okay. And so my total sales, what did I say these total sales were? I mean, total collections were 700,000. So even though I made sales of $1 million, I only collected 700. So this starts to begin to show the problems that we're going to run into. Are there any questions on the sales budget? Are there any questions on the sales budget? Now, we do certain things with these numbers in this budget. First of all, we're going to make some journal entries. So we got a journal entry for the sales. We got a journal entry for the bad debts. And finally, we're going to have a journal entry comma cash budget for the bottom one. So we're making journal entries, and also we're taking amounts to the cash budget. So once I've done these collections, I'm going to copy these numbers, and I'm going to come to my cash budget, and I'm going to paste them here. Ah, they don't come. Oh, yeah, I don't come out here. Do that. 200. Oh, they don't. What are these numbers? 41, 32, 41, 30. What I was trying to do was to bring these numbers down. I'll try it easily one more time. Let me just see if I can get the copy. Something. Okay, thank you. I have to do it manually. 130 and 220. And what was that final amount that I collected? 310. So every time you have one of these schedules, except for the production schedule, whatever is on that bottom line comes to the cash budget. Whatever is on the bottom line goes to the cash budget. Maybe I'll do what I've been doing before. Oh, let's see. Once again, let me just see if I can get these journal entries. Okay, so these are the journal entries that we're going to make. And they basically stay the same. We always start a company with cash. So somewhere in the assumption, it tells us the beginning cash balance. Initial cash balance invested by owners, 200,000. And that's what you'll be doing with your projects. So you're gonna debit cash, 200,000, and credit common stock, 200,000. Then our next number, we'll go in here and look at the sales. There were a million, they were all on credit. And we do that because that simplifies it. If not, there are gonna be issues with the bad debt. So we make this entry. Then we're gonna, I'll come back to this one. We're gonna do the bad debt expense, which is 100,000. So we're debiting bad debts 100,000 and crediting the allowance for 100,000. Then for these collections down here, we're debiting cash. And see, by making these journal entries based on what's in the cash budget, our financials and cash budget are going to tie in. So these journal entries cause them to tie in. Now, whenever you sell something, you got to make this COGS finished goods entry. And if you remember, we talked about direct costing. And if you remember, you based that selling price on only the direct labor and the raw materials. So direct labor and raw materials is what we're basing that on. And so if we sold 2,000 units, we got to go back to our assumptions and see how much the direct labor. So we look over here. Our direct labor was 49 and our raw materials is 50. So only these two numbers are going to be in inventory. So that's going to be times $99. So what's 2,000 times $99?
$198,000.
Okay. Okay. So how do we look here? How do we look? Hopefully you had your sheets out and you were making entries along with me. So hopefully you're making these entries with me. Are there any questions? Well, let's practice one then.
Excuse me, Professor.
Yes.
The last part for the course, you said direct labor and direct material.
Correct.
Or you only did for the material. You only did for direct material.
I thought we did both.
Direct labor was $1,
We're at $99.
which is for
You're right, because I only did, that's correct. I did the 49 and the 50. Should have been $100. You're correct.
thank you, sir.
Yeah, the labor, we should have had the $1 labor in here too. So this should have been 100. And so now this number is going to be how much? 200,000. Are there any questions? Are there any questions? So how are my assumptions coming for your projects?
Well, are we supposed to do step 3?
I just asked how they were coming. basically use the assumptions I have that now for the most part in terms of the percentages and where, but you have to put your things in. Well, let's just see what we're going to do. Since you all are trying to make this hard, so let me just see. So pull up another blank spreadsheet if you would. Pull up another blank spreadsheet. So on your blank spreadsheet, your sales are going to be $400. And they're all going to be credit sales. So all your sales are credit sales. And we'll make the collections 60% in the month of sale. And we'll make them 30% in the month after sale. Okay. So let's use 4 ink cartridges.
Wait, Professor, are you supposed to be showing your screen?
Am I sure? Why do you tell me?
We don't see it. I didn't know. I was just pulling it up. I was like, he's saying all these numbers and I can't see it.
I should be showing you. Okay, so make your selling price 400. We'll keep these percentages. You're collecting 60% in the month of sale and 30% the month after sale. For the raw materials, let's use 4 ink cartridges and 2 reams of paper. So 4 ink cartridges, 2 reams of paper, and the paper is costing $20 a ream. And we'll have you making 2 books per hour. The manufacturing overhead is going to be $200,000. So it's going to be $50,000. And I'm not going to change anything else. Okay, so I'm not changing anything else. So in this practice problem we're working on, our selling price is 400. Our bad debt is 10%. We keep those at 30%, but it's going to be 30% of the new selling price. Okay. So let's look what you should have. You got a selling price. So you're going to have to put these numbers over here, the new numbers over. And let's see if we have anything else over here. So, okay, so I'll leave the fixed expenses over here for you. So with this information, and since we're on break even, calculate the quantity to break even. Selling price 400,000. 4 ink cartridges, $10 a unit. 2 reams of paper, $20 a unit. You make 2 books per hour. Selling expenses still 30% paid quarterly. And your fixed expenses are 200, 100, and 200. So with that information, can you give me the new break-even quantity? Calculate for me the new break-even quantity. So how many are they going to have to sell to break even? Nobody has a break-even quantity yet. Well, let's see if we can move things over. How much is coming over for the selling price?
100,
400,
How much is the raw materials ink gonna be?
that's 40,
How much is the paper gonna be?
40,
Guess we do need a bad debt in here. How much is that gonna be?
that's 40.
We changed the fixed cost a little bit. We need some. How much of the selling expenses gonna be?
That's 12, 1, 12,
Ain't more than 12.
oh, 120.
120, 120.
Oh, this problem's gonna work out okay. We less than the selling price. So what's my total variable expense? So we got a selling price of 400.
Variable cost is 250.
So what, the ink is 40, the paper is 40. The labor we said was what?
10.
10.
Yes.
So put the labor in here, it's 10. Bad debts is what?
40,
Selling expenses,
120.
so what's our total variable cost?
That's 250.
So what's our contribution margin?
150.
And our fixed cost of what?
Fixed cost
200
200.
over here. And administrative expenses, 200. Interest expense, I think we kept that at 100,000. So what our total fixed costs?
500, 500.
1,000. So what's our quantity gonna be to break even? Oh, I got 150,000 in here. What's our break even quantity?
That's for 500.
3,333.
Let's go with that. 3,333. So what you gonna do with the 3,333?
Multiplied by sales.
Multiplied by 400.
We're gonna go to the schedule. This one fill out. Pull up the wrong one. Let's see. So once we make these calculations on this and we have it at the top, what are we going to do with that 333? What do we do with that 3333?
Put it in quantity.
So what?
What sheet are we on? We put it on the quantity side.
You have to say it's quantity, and it's going to be what? 3 3.
3,333.
So that's the next step. Then we got to put those percentages in for collections. And they were 10, 20, 30, and 40. So 10%. So you ready to go now? Can you finish it up now? So what we'll do is this. We will let you all work on it, and then we'll compare how you've come on this in the next class period. So it's kind of a standard thing, you know, it's procedural, and you have to work through it. So we'll review your progress on this, you know, this part of it, because I did it. I done, you know, if I go and do it again, then you won't get the sense of it. So you go and you work it out. And then we'll begin the process of finishing the budgets next time. Let's talk about that for a second. Where is my Excel? I don't know where this one came from. It's any of this. some reason, the other one has disappeared on me.
Professor, I still have problems pulling up course content through my Blackboard. You think that's something I just have to talk to them about? It's
Yeah, I
only
guess so.
it's only in your under your tab though, under the accounting tab. My other classes I don't have that problem. Is that a Blackboard? You think that's a Blackboard problem?
Yeah, I guess it is.
Okay. I'll see what I can see what I can do.
Live on some reason what we just worked on is disappeared. Let me see if it's on this one. Okay. What we will do would be to begin to work on these budgets. And we've done the sales budget. We'll go back over it. But what you need to realize is that this first line on the sales budget becomes the first line on the production budget. So whatever is on this line on the sales budget will become the line on the production budget. So once again, you see that your sales budget needs to be correct. So we'll start on the production budget next time. But you should be looking at it and realizing the first number on here is that sales number. Okay, so we will just pick up here next time. And once you work through it, you'll begin to see, it's not as bad as it might appear, but it's the steps you got to go through so you can balance out. So are there any questions, any last minute questions? Got it all down, Jennifer?
Sir?
Got it all down?
Oh yeah, I've been at it now. Don't need to worry about me. I'm good.
Okay, so we'll work on that sales budget again next time. Go through this, and I guess I will have you submit your sales budgets when we get back. So remember, you're going to be working on the sales budget on your project. And you're doing the same thing that we're doing now. Okay, so have a very pleasant weekend, but do finish up what we just did with the sales budget with that 333 and see if you can come through and get that down. Then we'll go back and review that next time, see how you all are coming. The other budgets, as you get to work with them, are not quite as involved, but this is the one that's most involved.
All right, sounds good. Have a good night, Professor.
You all have a good night too. We'll see you all on Tuesday.
Good night.
Good night, sir.
Good night.
Good night, Professor.